Hi guys, Tunapan here, founder of Master the Markets, Elite Traders Conference and the Traders Open Day. So today's topic is going to be on 3 types of stop losses. Now this is a very critical topic, traders, because you see stop losses and all that comes under the category, the topic of risk management. Now risk management is such a pivotal, important and critical topic. Now why is that? Because professional traders and professional investors, the first thing that they always think about, constantly think about before they get into a trade or an investment is not how much profit they're going to make, is how much they can afford to lose. Because you see traders, the only control that you have when you enter into a trade and you're in the trade is only the risk factor. Because most of you all would not have the capital power to control that trade. Okay, it's a collective pool of people's thoughts and a lot of other factors that come in, which actually then determines how the price moves in the market, especially how smart money enters the market actually. So in terms of, in line of all of that, the real power that you have, the real control that you have is your risk management. Okay, is how much you can afford to lose. Now in terms of that, we're going to be looking at the 3 types of stop losses and how to stop your loss when the market does something which is not favorable to you and not in line of the direction of the trade that you are taking on. So let's take a look at the 3 types. The first one is what we call, and it starts with the letter T, some of you might have already figured it out, is called the technical stop. Okay, the technical stop, and this is the one that most people will be familiar with. Most 98% of traders will be familiar with this, because out of all the 20,000 people, all of the 20,000 traders that we've coached, talked to and everything, they all know this. They don't know the other 2, so I won't be surprised if you guys don't know that as well. So the first one is called technical, and that's where all your kinds of stop losses comes under, where you place your stop loss on the moving averages, channels, trend lines, all that so on and so forth. Okay, so all that is summarized under technical stop losses. Even like if you use ATR kind of base stop losses, they're all under technical stop losses. Okay, the second one is what we look at and we'll talk about, is called a money stop now. Okay, money stop. Now what do we actually mean by a money stop? Now a money stop is basically one where you write in the rules, and this is how you execute the trade as well, is that you say, let's say for example, I enter the trade into this retracement here. Now it's going well in profit. Okay, well in profit. You tell yourself you start to trail your stop loss to break even as soon as the trade, let's say, is 3% in profit. I'm just giving an arbitrary number here. 3% profit. You don't care where the moving averages are, where the price bar pattern is, or whatsoever, what's or not. You would just move your stop loss to break even. Let's say just over that. So that is purely based on money. Okay, purely based on money. Okay, that's why it's called a money stop, because the stop loss is adjusted according to your profits or your losses. Okay, mainly, usually, all the time, usually is through your profits. Okay, that's when you trail and then adjust your stop loss. The final one, traders, the final one is, in fact, okay, I'll come back to that later on. The final one is the time stop. The time stop. Okay, now as you would have already thought about already, the time stop is based on time. Okay, so for example, especially if you're intraday trading, this is very important, because certain times of the day volume is really high, and certain times of the day the volume starts to dry up. Okay, so especially if you want to capture, let's say, a certain percentage of the move, you want to capture it before a certain time. You usually know that after 5-6 p.m. usually volume usually dries down. Price movement is not really that much, especially towards 9 p.m. So you can have then a rule saying, oh, you know what, let's say at about 5 or 6 p.m. I'll look at exiting trades if it's not reached my objective. Or if you're a swing trader, you will start saying things like, if it's consolidating for 10-15 days in a row, I will possibly exit out of the trade. So all that is basically based on time. Okay, now let me ask you all a question, right? So out of all these 3 stops that I've just talked about, technical, money and time, What do you think is the most strongest stop of them all? What do you think is the most strongest stop of them all? I think, if my guess is right, as we have coached over thousands and thousands of traders, most of them usually tell me it's either the technical or the money stop. In fact, let me tell you traders, the weakest one of them all is the money stop, okay? Because there's no basis for it, just basing it just on money and just like trailing it, okay? The most strongest one is actually the time stop, actually, time. Because everything is determined on time. We are time bound in everything that we do, because in terms of, even if you look at your daily activities, in terms of waking up, like having a lunch, your meals, coming back from work, going to bed, it's all based on time, time bound. Even in fact, your life is time bound as well. Do remember that. Now, the final one, the first one will be this one, then second is this, and then third is this, okay? And that's how we usually rank it. But here's the final most critical point. If you actually want to make your risk management really, really strong, the trick is not to put your emphasis on either one of them according to their strength, but to make them sync with each other so that they can then adapt to market conditions, okay? So it's basically a confluence of the stop losses, confluence of these types of stop losses that can help you then generate these rules which can then adapt to market conditions. So for example, let me give you an example such as, in the beginning when you start off with the initial stop loss, put it behind a technical place, and as time then moves by, then you would then get more aggressive with your stop loss, and as it's nearing towards exit, if you have reached a certain profit potential and still price is still hovering around, losing momentum, then you would then start to go into money stop. Especially money stop will be very useful if you're into swing trading, push swing trading, especially if you're holding onto a position for like 1 month or 2 months and your stop loss is so far away, you don't want to give up so much of those profits. For example, when we took the Dow Jones trade, when we took that 2,000 point move on a mismatch strategy, when it already done 80% of the move, we use money stop because we don't want to give back all that profit back to the market, okay? So that's when we start to use money stop in a combination of time stop and initially starting off with technical. So that's how you can do it. Do have definitely a good think about this, because this is so critical, traders, because if there's only one thing that you have total control of, it's your stop loss, it's your risk management, okay? So do definitely have a very, very good think about this, contemplate about this, and go and revisit back all your strategy rules and see how you can optimize that for optimal maximum performance out of your strategy. Okay, I believe that you have really enjoyed some really amazing value from that video, and as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master.